Today, we will talk about indicators, what they are, how they're used, and the types and examples. Indicators are statistics used to measure current conditions as well as to forecast financial or economic trends. In the world of investing, indicators typically refer to technical chart patterns deriving from the price, volume, or open interest of a given security. Common technical indicators include moving averages, moving average convergence-divergence, relative strength index, RSI, and on-balance volume, OBV. In economics, indicators usually refer to pieces of economic data used to measure the overall health of the economy and predict its direction. They include the Consumer Price Index, CPI, Gross Domestic Product, GDP, and unemployment figures. Indicators can be broadly categorized into economic indicators and technical indicators. Economic indicators are statistical metrics used to measure the growth or contraction of the economy as a whole or sectors within the economy. In fundamental analysis, economic indicators that quantify current economic and industry conditions are used to provide insight into the future profitability potential of public companies. Technical indicators are used extensively in technical analysis to predict changes in stock trends or price patterns in any traded asset. There are many economic indicators created by different sources in both the private and public sectors. For example, the Bureau of Labor Statistics compiles data on prices, employment and unemployment, compensation and work conditions, and productivity. The ISM Manufacturing Report on Business contains a composite index, the Purchasing Managers Index, which is a closely watched barometer of economic activity. Housing and real estate have been leading economic indicators for most of the 21st century, and there are several metrics used to measure housing growth including the S&P/Case-Shiller Index and the NAB/Wells Fargo Housing Market Index. Other economic indicators include interest rates, the money supply, and consumer sentiment. In the context of technical analysis, an indicator is a mathematical calculation based on a security's price or volume, and the result is used to predict future prices. Common technical analysis indicators are the Moving Average Convergence-Divergence Indicator and the Relative Strength Index, RSI. Using tools like the MACD and the RSI, technical traders will analyze assets' price charts looking for patterns that will indicate when to buy or sell the asset under consideration. One of the most common economic indicators is the Consumer Price Index, which is simply the weighted price average of a basket of consumer goods and services. Changes in CPI are used to measure changes in the cost of living and to identify periods of inflation or deflation. For example, in April 2021, the CPI increased 0.8%, making it the biggest 12-month increase since September 2008. Here are 5 key takeaways. 1. Indicators are statistics used to measure current conditions as well as to forecast financial or economic trends. 2. Economic indicators are statistical metrics used to measure the growth or contraction of the economy as a whole or sectors within the economy. 3. In the context of technical analysis, an indicator is a mathematical calculation based on a security's price or volume, with the results used to predict future prices. 4. A key performance indicator refers to a quantifiable measurement used to measure a company's success against a specific target or objective. 5. Commonly used indicators of a company's profitability include gross margin, operating margin, net margin, and return on equity, ROE. Hope this would help. Thanks for watching.